Hello, property navigators. Today, we will help you better understand the ins and outs of buying property through your self-managed super fund, also known as an SMSF. Buying property through a self-managed super fund has gained traction in recent years. According to the ATO data, there are more than 610,000 self-managed super funds with 1.1 million members. I'm not giving individual advice today. This is general advice, and you should seek personalized legal, financial, and tax advice based on your circumstances. So now you can't sue me, let's get into this. Why has this taken off? Over 1.5 million households have investment properties. 384,000 households own 2 investment properties and 18,000 have 5 or more. So the desire for property investment is deeply ingrained in Aussies. This has naturally extended into the realm of superannuation, where individuals are now looking to maximise their retirement savings through strategic property purchases. One key reason for the popularity of SMSF property investments is leverage. Superannuation can be leveraged to buy a high value asset. For example, and using round numbers, a person or a couple could use $250,000 of their superannuation to set up an SMSF and purchase a $1 million property. Let's break it down again using round numbers. Leaving $250,000 in a superannuation fund with a 10% return would yield a $25,000 return per year. However, using that $250,000 to buy a $1 million property with the same 10% growth rate results in a $100,000 capital gain per year. The internal rate of return could be much higher by leveraging that $250K to make the return on the $1 million property investment. And this is the key to the strategy. The leverage can allow for substantial capital growth to be achieved compared to just relying on traditional superannuation investment returns. SMSFs can amplify returns by using borrowed funds to invest in property to make the higher returns, while also allowing diversification across both investment instruments. If both superannuation and the property markets perform at 10%, they could see a significant return on investment. Pretty simple when broken down, right? There is a ton of intricacies to understand. Each individual situation is unique, and professional advice will ensure you make informed decisions tailored to your financial goals. Now, we don't set up SMSFs or anything like that. We are all about finding the right high-performing property for the SMS to achieve its goal. Here's some general info we've learned that might be good thought starters for you and your understanding. First of all, a team. An SMSF isn't a structure you want to set up yourself. Your success might very well be in the structure you create for this. It requires building the right team around you. This team should include a mortgage broker, accountant, financial planner, lawyer, and potentially a good buyer's agent to find a property that serves its purpose. Each professional plays their own vital role. Now, we know knowledgeable and trustworthy professionals that can have an honest conversation with you if you don't know where to start. Loan. When it comes to SMSF lending, the loan is typically the last part of the process, but it's important we cover it here first. As of 2018, all major banks pulled out of lending SMSF loans, so you can't just walk into a branch. The expertise of a not just good but great broker for SMSF loans is essential, as it adds expertise and simplifies the process. Find one that's done a lot of these loans, as they don't operate the same as residential loans. An SMSF loan does not affect personal borrowing capacity, and investing through an SMSF does not affect your after-tax cash flow. Your SMSF services the investment property using rental returns and superannuation contributions. It kind of quarantines all the profits and expenses into your SMSF. This approach allows building wealth without impacting personal finances. As borrowing capacities have decreased due to the rising interest rates, exploring SMSFs as an alternative vehicle for property investment can be clever. SMSF loans are known as what are called limited recourse borrowing arrangements. They typically have a high interest rate, and as per Australian Financial Review, LRBAs are a complex structure that have special rules that include not being allowed to use any SMSF assets as security against any other investment. Therefore, the rules specifically prohibit the strategy of using any equity in the property as investment to finance another property. The LRBA requirements effectively mean you are unable to access the equity in your current properties. So you cannot, for instance, switch to another lender who is willing to lend your fund more than is currently outstanding on your existing investment if the intention is to use any part of the new loan towards making another investment. A strategy your financial advisor might employ to get around this might be to have an offset account that is used to deposit excess contributions and rental income. Now, this would effectively be a return by offsetting the 7 or 8% interest rate on your SMSF loan, but using that to generate usable equity in the form of cash. So rather than paying down the loan and getting it to zero, then thinking you can go ahead to buy another property in your SMSF and being told you can't because you can't use equity in those properties, you are saving for your next deposit. Property. There are specific guidelines and conditions for self-managed super fund property investment. There is a sole purpose test that the ATO uses, which is crucial to understand. The Australian Tax Office requires that all activities of super funds must be for the sole purpose of providing retirement benefits for their members. Residential properties purchased through an SMSF must be purely for investment. They cannot be used by family members or for personal enjoyment. This rule ensures that the assets held within the SMSF are dedicated to generating retirement benefits and are not used for personal gain before retirement. So there's no renting it out to family members, which I believe is one of the rules, even if rented at market value. There's also a lot of questions people ask, like, can I develop it? Can I add value? Can I put another story on it? Can I put a granny flat on it? Well, you can't really do these either, I believe. Remember, you can't draw equity on this property. You can possibly do some minor maintenance or cosmetic renovations, but even if it's minor cosmetic renovations, you will want to get some advice to make sure that you're not doing anything wrong from the ATO's point of view. It's pretty strict. But what is interesting is if you're a business owner and you buy a commercial property. Business owners can own their premises through their SMSF, becoming their own landlord and benefiting from the rental income. Now, this offers more flexibility and passes a sole purpose test because it's a totally different entity. This approach allows small business owners to build business wealth through their SMSF while quarantining it from any business risk. By owning their commercial premises, business owners can control their rental expenses and benefit from the property's appreciation over time. Another common question is the minimum super fund balance needed. Generally, I believe a balance of $250,000 is recommended, but it could be more or less. I've spoken to people that have had as low as $150K. It's all given your own personal situation. Lenders look at factors like your fund's contributions, rental returns of the property, historical performance, and LVR plays a role too. For example, a personal couple's super contributions could be $20 to $30K per year, in which case this amount would service the SMSF and supply excess liquidity. Some lenders say that they will accept a loan-to-value ratio or LVR of 90% on a case-by-case basis, depending on the security of the contributions, i.e. your serviceability, rental income, etc. So these variables all feed into a person's individual circumstances. And lastly, to touch on some narratives you may have heard that are probably from industry super funds that say SMSFs aren't necessarily the best selection for a person, particularly in property, due to the low liquidity and low returns. Well, they do seem to ignore the capital growth on the investment, which is obviously key to what you are trying to achieve, and it's all achieved through leverage. Thanks for joining us today. We've covered a lot of ground. Get in touch if you want to chat more. Until next time, happy property navigating.